Hi, my name is Balbina Ramirez.
Hi, my name is Greg Melhop.
Hello, I'm Julia Webb.
Hi, my name is Raul Alvarez.
Hey everybody, welcome to our presentation on Adelphia. Today, Julia will be discussing the company, industry, and the market, as well as the natures of the issues. Then Raul will jump in and discuss the related party disclosures, and then also discuss the 2010 Form 10K. Then Balvina will jump in and discuss the other disclosure statements, and I'll wrap it up by discussing off-balance sheet financing. Hope you guys enjoy the presentation.
It is a case about betrayal, the betrayal of shareholders by executives who put their own interests and their own pocketbooks first. The financial fraud at Adelphia was orchestrated by the family of John J. Regas, who founded the company in 1952 and took it public in 1986. Mr. Regas and his sons Timothy, Michael, and James, with the assistance of two senior officers, James Brown and Michael Mulcahy, oversaw a massive effort to disguise and distort the company's financial picture and to engage in rampant self-dealing that enriched the Regases at the expense of the shareholders they were supposed to be serving. From at least 1998 through 2001, Adelphia, through the defendant's charge today, fraudulently understated its liabilities by approximately $2.3 billion. Adelphia overstated its financial performance, including its earnings, exaggerated its operational performance, including total number of cable subscribers and the percentage of its plant that was upgraded, and concealed the rampant self-dealing by the Regas family, including the expenditure of more than $12 million of Adelphia funds to build a golf course on Regas-owned land, and the expenditure of more than $242 million in Adelphia funds to pay the Regas' personal margin call.
Hello, I'm Julia Webb, and I will be discussing the description of the company, industry, and market. John Regas was the founder and CEO of Adelphia Communications Corporation, a cable television operator that grew exponentially fast. Regas founded the company in 1952. However, being that the cable industry was not in high demand during this time, it was long after the founding date that Adelphia began its fast growth. Regas started the cable corporation as a family business with his brother Gus Regas and chose the name Adelphia for its Greek meaning of brothers. In 1972, John and Gus Regas incorporate the company Adelphia, and it becomes the company's inaugural year of business. During the 1980s, John Regas began to reap the benefits of having a slowly developing cable company years prior, due to the cable market rising in the homes of many Americans. Adelphia Communication Corporation served as an umbrella for several other cable properties owned by Regas. Included in this beginning set was Clear Cablevision Inc., Indiana Cablevision, Western Reserve Cablevision, and International Cablevision, serving approximately 200 subscribers in total. This cable group, based in Pennsylvania, was the start of Adelphia Communications, and the start was promising, with the first annual sales reaching $30 million. The 5 original companies that formed Adelphia was not enough for Regas. He began his acquisition strategy shortly after taking Adelphia public in 1986 by purchasing Suburban Buffalo System, South Dade System, and Newcastle System. Regas continued to acquire cable systems, and by the end of 1989, Adelphia owned 10 cable systems throughout 8 neighboring states. Adelphia soon began to have more expenses rather than profits due to its quick expansion. but the goal of write-ups was the long-term effects of the acquisitions. The company experienced lower profits due to the expenses from the many acquisitions. However, this began to turn around by Adelphia seeing the results of their aggressive expansion by 1988, with profits going up to $131 million. The company also had a promising future by continuing its strategy of acquisition growth and targeting cable systems that were in close proximity to Adelphia's market. Jones Intercable was a significant purchase for Adelphia during the end of 1989, with Jones Intercable System being the third largest cable system operator in Western New York. In addition to Jones Intercable, Adelphia also formed a partnership with a company to form Olympus Communication, based out of Florida, which was a cable television venture that Adelphia would manage for a fee. In addition to Adelphia's acquisition plans, they also had internal plans for redeveloping its infrastructure by upgrading its systems. In 1990, Adelphia announced it would start a 5-year, $25 million system redesign, including increased cable coverage, fiber optic networks to increase the number of cable stations, and sharper television images. Adelphia was experiencing high cash flow. By 1992, the company was the 10th largest cable provider in the country, and its operating margin was 57% revenues, which was much higher than the U.S. cable industry average of 35%. With the many acquisitions and system upgrades, by 1992, Adelphia had expended $350 million on the foundation of the company's success by offering state-of-the-art cable systems and good quality cable service. Concerning the market, Adelphia also passed the average cable operations by achieving a high demand from mid-size and suburban markets where family incomes were high and family sizes were growing. This would continue to provide high sales for Adelphia. Adelphia continued to grow throughout the 1990s, with sales reaching $267 million in 1992 and sales rising in 1993 to $305 million. During the late 1990s, the cable industry embarked on a high market arena, with many companies merging and buying smaller companies and surprisingly exchanging systems with one another to maximize economies of scale. While the industry became aggressive with other companies merging, growing their markets, Adelphia decided to acquire large companies that would cost Adelphia billions of dollars. In February of 1999, Adelphia acquired Frontier Vision Partners. It cost Adelphia $550 million in cash, $431.4 million in stock, and Adelphia assumed $1.1 billion in debt from Frontier. The month after purchasing Frontier, Adelphia purchased Century Communications for $3.6 billion and assumed $1.6 billion of Century's debt. In April of 1999, Adelphia made another acquisition, purchasing Heron Communications Corporation cable system, totaling $1.17 billion in cash. The three large acquisitions allowed Adelphia to reach over 5 million subscribers. However, the large payout for each acquisition may have resulted in major cash management system issues for Adelphia. Now I will discuss the description of the natures of the issues. The prosecutors of the Adelphia case said that the Regis Company had multiple issues with financial statements and disclosures. One was the complicated cash management system. Two was fraudulently excluding billions of dollars in liabilities from its consolidated financial statements. Three was that Adelphia falsified operations statistics and inflated Adelphia's earnings to meet Wall Street's expectations. Four was that the Regis family used corporate funds for Regis family stock purchases and the acquisition of luxury condominiums. The SEC also alleges that since 1986, Adelphia improperly netted or offset related party payables and related party receivables. As a result of this offset, gross related party receivables of $1.35 billion and gross related party payables of $1.34 billion were reported as approximately $3 million net receivable. The natures of the issues for Adelphia are the improper use of funds and the lack of proper use of GAAP-approved balance sheet statements. In an interview with USA Today in 2007, John Regis says the case wasn't really about fraud. He says it was a case of being in the wrong place at the wrong time. What Regis may have forgotten is that his company was a public company with stockholders involved and public funds collected. Adelphia also lacked a fully developed statement of cash flows, and without a strictly implemented statement of cash flow or financial statement, a large business like Adelphia could easily offset their net and related party payables and receivables. Acceptable principles for financial statements would have resulted in Adelphia properly noting their transactions in their statements for transparency by utilizing footnotes if they made purchases with corporate funds. The proper use of a balance sheet would have also prevented the exclusion of liabilities. The main elements of a balance sheet is the equation of assets equals liabilities plus equity. By not using the equation for the main flow of their statements also caused a problem and excluded billions of liabilities. Not recording liabilities can result in overspending and misleading investors and stocks. Also, the cash flow statement did not have a clear format consisting of operating, financing, and investing activities to disclose the inflows and outflows of operating expenses, investing activities, which would include the many acquisition expenses for Adelphia, and the financing activities, which show the loans and credit lines that Adelphia contained. The most important, and in my opinion, the easiest part for financial reporting that Adelphia did not accomplish was the easy to read and transparent financial records for all of their company operations, including investments, loans, assets, real estate, and revenues.
Question 1, Related Party Matters. Review FASB ASC Topic 850, Related Party Disclosures, which is available on FASB's website, www.fasb.org. The following was retrieved from the FASB website. It states that related party transactions should include the following to ensure proper disclosure in financial statements. 850-10-50-1. Financial statements shall include disclosures of material related party transactions or other than compensation agreements, expense allowances, and other similar items in the ordinary course of business. However, disclosure of transactions that are eliminated in the preparation of consolidated or combined financial statements is not required in those statements. The disclosure shall include the following. 1. The nature of the relationship. 2. A description of the transaction. 3. The dollar amounts of the transactions. 4. Amounts due from related parties. 5. Information required by paragraph 740-10-50-17. Question number 2. Use Edgar www.sec.gov to access the 2000 Form 10-K for Adelphia Communications Corporation. Examine Adelphia's balance sheet and locate line item Related Party Receivables Net. Next, look up and read the Related Party Note, Note 13. Do you believe that this note adequately explains the nature of these related party receivables or meets the disclosure requirement for related party transactions? Justify your answer. Well, according to Adelphia's balance sheet, there is one related party visible on its balance sheet, which is the related party receivables net. The related party net receivables totaling $178,577 and $3,071 in 1999 and 2000 respectively. This was not properly disclosed in Note 13. Note 13 discloses various commingling transactions between its entities, but fails to mention any comments in regards to its accounts receivables. There are no notes or comments that describe the amounts or the parties involved in the related party accounts receivables. This must be presented on its financial statements so its shareholders and its investors will understand that these transactions are either related or at arm's length transaction. Since there were no proper disclosures, Adelphia Communications violated FASB ASC Topic 850 Related Party Disclosures. Note 13 in 2010-K, the related party transaction was noted. At that time, Adelphia managed a cable system which were principally owned by limited partnerships in which certain Adelphia principal shareholders who are executive officers had equity interest. Adelphia has agreements with Olympus and the managed entities which provide for the payment of fees to Adelphia. The aggregate fee revenues from Olympus and the managed entities amounted to $2,022, $5,033, $34,905 for the 9 months ended December 31st, 1998, and the years ended December 31st, 1999, and 2000 respectively. In addition, Adelphia was reimbursed by Olympus and the managed entities for allocated corporate cost of $7,548, $7,785, $6,144 for the 9 months ended December 31st, 1998, and the years ended December 31st, 1999, and 2000 respectively, which have been recorded as a reduction of selling, general, and administrative expenses. Interest expense net includes interest income from its affiliates for borrowings of $14,560, $56,719, $40,033 for the 9 months ended December 31st, 1998. The years ended December 31st, 1999, and 2000 respectively. At March 31st, 1998, Adelphia had interest rate swaps, which affiliates for a notional amount of $175,000, which expired during the 9 months ended December 31st, 1998. The net effect of these net effect swaps was to increase interest expense by $2,049 for the 9 months ended December 31st, 1998. During the 9 months ended December 31st, 1998, and the years ended December 31st, 1999, and 2000, Adelphia paid $3,422, $11,227, and $15,864, respectively, to entities owned by certain shareholders of Adelphia, primarily for property, plant, and equipment. Did Adelphia properly disclose its receivables as outlined by the FASB ASC Topic 850? No, Adelphia did not properly disclose its net receivables as outlined by FASB ASC Topic 850 related disclosures. Adelphia did not disclose the amounts or the relationships of its receivables, which did not give investors a clear picture if the transactions were done at an arm's length transaction.
Thank you, Raul. What is the significance of Adelphia's treatment of related party receivables and payables and the company's failure to adequately disclose its related party transactions? In other words, why is this wrong? Besides the fact that this violated GAAP standards, it is significant because it distorted the truth and it misled investors and stockholders. The Rigas family was able to use Adelphia Communications, as many have said before, as their own personal ATM machine. By using complicated cash management systems, also called CMS, they were able to commingle Adelphia's funds with Riga family entity funds. The general ledger system shared by Adelphia, its subsidies, and the private Rigas entities allowed intercompany transactions, which flowed into the CMS as cost centers. Related party transactions that the Adelphia's auditors were aware of. If the bank statements were reviewed, it would have been proof that many deposits were done to the same CMS bank account, and all disbursements were also made from the same bank account for both public and private companies. Not only was the commingling of funds, but they also intentionally omitted debt, also called off-balance sheet debt, was not part of the consolidated Adelphia financial statements, which inflated Adelphia's net earnings to meet stockholders' expectations. The chart provided by the AICPA regarding this scandal, it clearly shows the many transactions that Adelphia was doing with Riga family's entities. The Rigas family owned the Buffalo Sabres hockey team, in which they would sell tickets to Adelphia. The second company owned by the Rigas family was a family-owned farm, which was used to obtain money from Adelphia as return for services such as landscaping and maintenance. The third company owned by the Rigas family was an interior design shop, which sold ridiculously expensive furniture to Adelphia and was also charged millions of dollars for internal design services. The fourth company that the Rigas family owned was a private car dealership, which leased vehicles to Adelphia. Is this totally wrong? One could argue that the Rigas was selling a product and service to Adelphia in return for money. However, when it's not disclosed, it can easily become a vehicle to commit fraud, as the Rigas took advantage of by charging outrageous amounts of money when those products and services could have easily been done by other vendors at a much lower price. Adelphia's money was used for their personal advantage without stockholders' consent, and it is wrong at all levels. Why is it important that companies disclose related party transactions? For a business, one of the management's goals is to reduce costs when possible, so that their net income is higher than the costs incurred. When reviewing a financial statement, we have an assumption or belief that the transactions were negotiated on an arm's length basis, meaning that both parties in the deal are acting in their own self-interest and are not subject to any pressure or duress from the other party. However, the assumption cannot be made when related party transactions exist, because the required conditions of negotiations are most likely not required. Most companies, when a certain amount is going to be spent, management is required to obtain proposals from different companies to make the decision what vendor to choose. This slide shows an example of approval process, which is good to have to demonstrate due diligence when making a decision on large contracts or projects, a process that I doubt Adelphia had in place. It is important to disclose all related party transactions because GAAP requires full disclosure of all material terms of related party transactions, including the nature of the relationship, a description of the transaction, and any dollar amounts involved. By providing such disclosures, financial statement users such as investors and stockholders are able to discount those amounts if needed for their financial analysis and projections of the company. Self-created question number 1. Besides filing a Form 10-K, what other information should a company disclose? We have a few suggestions for full transparency. Number 1, disclose the relatives of management who are on the payroll, including what they do for the company. Number 2, disclose transactions with vendors who are related to management. Number 3, disclose management transactions with investment bankers who do business with the company. Now I turn it over to Greg.
The largest thing plaguing Adelphia and what caused them to go bankrupt is their off-balance sheet liabilities. By the time they went bankrupt, they had $2.3 billion, and that's billion with a B, dollars of liabilities and off-balance sheet financing. What off-balance sheet financing is a way for a company to omit liabilities from their balance sheet by channeling them through other means. There's two major ways to process this off-balance sheet financing. The first way is through operating leases. An operating lease allows a company to purchase a large ticket asset under a lease program where they're going to make monthly payments just as if it was a loan. However, the company would only have to book as expense the monthly payment that's made. It's usually booked to some form of lease expense or rental expense account. So within the year, the company would only have the 12 payments of expenses to their liabilities. However, when a company typically purchases a large-scale asset and they would finance it, they would have to immediately book the entire value of the asset and also immediately book the entire purchase price as a liability. So what happened there was a company only had to book 12 months of rent payments on maybe a 5 to 10 to even 15-year lease, as opposed to actually booking the entire purchase price. For example, if a company were to purchase $1 million item that was paid in equal installments over 10 years, they would make $100,000 payments every year. So their expenses in any given year would be $100,000, and there would be no liability booked. There'd be no leverage. If a company were to purchase the same asset and leverage it, they would immediately get an uptick in assets of $1 million. However, their liabilities would also increase by $1 million. So you can see the annual benefit from operating through off-balance sheet financing. The other form of off-balance sheet financing is enduring partnerships. When a company benefits, or when a company funds a partnership, those funds are no longer within the company. Let me explain. So when a company pays for, let's say, R&D for a given partnership, those liabilities now sit on the balance sheet of the partnership. However, when a company reports their balance sheet, they don't need to report the liabilities for any partnerships they're part of. This was made famous in the Enron scandal of 2001, where they had multiple partnerships that were tying up all of their cash reserves and eventually led to the fallout of Enron. As you can see, off-balance sheet financing, while technically legal and possible through GAAP standards, presents a real possibility for misrepresentations on the financial statements. And when looked at financial statements without looking at disclosures, you can find yourself really reading misrepresented data. Now that we understand what off-balance sheet financing truly is, let's go over some reasons why a company would want to operate under off-balance sheet financing. Obviously, the main reason is simple. They want to reduce their exposure, they want to reduce their debt, they want to reduce their leverage. Right, but let's get into some reasons of why they would do it. Because knowing why a company would do it would allow a reader of financial statements to be better prepared to notice when there's misrepresented data. The first reason is the cost of debt. As a company incurs more and more debt and becomes increasingly leveraged, the total cost of debt becomes higher and higher. For example, it might be as simple as an interest rate gets higher and higher. Another reason are financial covenants and previous agreement restrictions. When a company enters into an agreement with a credit grantor, often there's built into the agreement certain stipulations that would call for a default of that financing, whether it's certain performance on financial ratios or it's simply just total debt allowance levels. Once a company is not performing to the target of the ratio or over the allowance for debt, the credit grantor can immediately call the loan and say that it's in default. Another reason is for liquidity creation. When a company is purchasing an asset, it ties up their capital. If they don't tie up their capital, they're more liquid. Simple as that. Another reason is for debt availability. A lot of times a company will operate with what's called a revolving line of credit, just like a credit card for the average consumer, however, usually on a larger scale. For example, a company might have a $5 million credit line, but built into the credit line, it might also have stipulations for debt. So you may be able to pull $5 million, the company may be able to pull $5 million rather. However, if the total company is leveraged, say, over $20 million, they could cut off the revolver altogether. So, again, it comes back to cash availability. If they are over a certain level of debt, they may lose out on that cash availability. There are many reasons why a company would want to reduce their debt. The most logical reason being that it creates what's considered or perceived to be a more valuable company. The reason we need to know all these things is so that we as investors or just smart financial reporting, reading individuals can understand when this misrepresentation might be taking place. On behalf of our entire group, I'd like to thank each and every one of you for watching our presentation on Adelphia. Please post any comments or questions you may have in the fields below, and we'll try to get back to them as soon as possible. Thanks for watching.